Okay, we'll go ahead and get started. Thanks everyone for tuning in. I'm Scott Duba, Chief Investment Officer at Prime Capital, and this is our Making Sense of the Market quarterly webinar, a guide for plan participants and investors on April 10, 2024. I'm joined again by my colleagues Eric Kraus, who's a portfolio manager in our Fayetteville office and an investment strategist on the team, as well as Will McGuff, who is also an investment strategist in our Overland Park office. Today we're going to, well, before I get into the agenda, for those of you that are not familiar with PCIA or are newer clients to the firm, just so you know that we serve the wealth management clientele, retirement plan sponsors, as well as institutional clients. We serve over 15,000 households, over 800 plans, have a firm AUM of approximately $25 billion, and clients in 48 states. So if you have additional needs regarding investment management or wealth planning, please ask your advisor and they can surely help. So today, we're going to level set on the very interesting solar event of last week, the totality, the eclipse. Hopefully many of you had the chance to observe it safely with appropriate viewing goggles. And we're going to try to do the same thing for you today. When you're looking at the market, we want to make sure you have the right visual protection and the right information to make sense of what you see in the markets at a time when, like a solar cycle, we have different events occurring on a annual, biannual basis. So my colleagues and I, Will and Eric, we're going to try to provide you the proper viewing of the market today, much like you had of the eclipse earlier in the week. If we start with current headlines, as always, we had a very good first quarter. The S&P recorded a number of new record closes. If you look at some of the more speculative assets in the market, such as Bitcoin, they're up significantly, which we view as a bit of a signal of more greed than fear in the market. On the international front, China continues to cause some concerns. A little bit of uncertainty remains with respect to their ongoing economic prospects. We obviously have a U.S. presidential election on the horizon, which could cause market volatility. And we still have simmering hot conflicts in both Europe and the Middle East, which always keep the markets on edge. And just this morning, we had inflation come in hotter than expected for CPI at 3.5% in March, which is tamping down earlier in the year expectations of multiple Fed rate cuts. And as a backdrop, with the strong economic growth, we have commodity prices higher. Oil in particular has reached new highs. And of course, we have the always topical and headline dominating artificial intelligence theme, which we'll get into in more detail as we get through some of the materials here. So to open up, I think the first question we like to start with is, how does the 2024 market performance thus far compare to prior years? And so I will turn this over to Will McGuff to answer this question. Will, how are we looking so far in 2024?
Yeah, thanks, Scott, and thanks everybody for tuning in today to Making Sense of the Markets. And one of the headlines you just showed said it was a monster quarter for the S&P, and the S&P was up 10% Q1. That's actually happened 11 times in the S&P's history. You may be wondering how the rest of the year plays out of those 11. Well, 10 of the 11 are up for the rest of the year. The S&P was also up in January, February, and March. So each of the first 3 months of the year, the S&P was positive. That's actually happened 20 times throughout the S&P's history, and then 19 of those 20 have been up for the rest of the year. But how much it up is to be determined with all the factors that are going on in the market, which we'll get into in this presentation. You'll see the S&P's only been down 2% with the drawdown for the year. We've got a long way to go, and I would probably expect a little bit more volatility the rest of the way than we've seen the first 3 months of the year. What's causing that volatility? We can thank rates, which is the next slide if you want to hop forward one. So we're looking at the bond aggregate index, which is a proxy for how the US bond market is doing as a whole. And obviously the one thing that sticks out on this chart is 2022 Bonds were down 13%, the 17% drawdown. We had a little bit of a recovery last year with bond ag up 6%. As you can guess, with rates ticking a little bit higher, bond prices tick a little bit lower, and so it's kind of a moot quarter with the 1% loss for the bond ag. It's already been down 3% this year, which is kind of in line with all the red dots you see throughout history. As we zoom out a little bit further and look at asset classes on the next slide and how they ebb and flow over the years, you'll see large cap US equities, the green box, top right, up most year to date and 2023. So that 10.6% return is top right, is the best there. If we go bottom right, real estate's the worst performing asset class, and it's one of my favorite trivia questions is what's the best performing asset class over time consistently. If you look at the top, you'll see 2010, 2011, 2012, 14, 15, 2021, real estate. So real estate typically is a good performing asset class, but not so much this year. And it's just going to be something interesting to see how the rest of this year plays out with regards to all these asset classes. With that, we'll turn it back over to you, Scott.
Thanks, Will, for kicking us off there. So, Eric, you're a portfolio manager. You manage a lot of custom accounts for portfolios. Why don't you take this one? What's going on under the hood of the broader equity market? Will's kind of given us the high-level aggregate broad strokes, but if we dig deeper, what story do we see being told?
Well, I'm going to actually let you take that one here in just a minute, Scott, with your deep dive on AI. But if you go to the next slide, you can see the path that we've been on for the S&P 500. Excuse me. So we've actually been through 3 bear markets in the last 5.5 years. I think sometimes that goes unnoticed by people because the one that we experienced at the end of 2018 almost looks like a blip on the radar here. But we actually had a minus 19.5%. I'll call that a bear market, minus 20%. At the end of 2019. Then we had a COVID crash of minus 34%. And then we had that minus 25% experience that we had in 2022. And so it's easy to think as an investor, gosh, things have been kind of rough. But realistically, when we look at the long-term trajectory of this chart, that kind of sticks with the trend. If you just kind of drew the line all the way from 2008 all the way forward here, we've had this nice long projected uptrend. And it's nice to see that we are hitting those all-time highs again with the S&P 500 touching the 5250. That's kind of the range that we've been stuck at here for just a short period of time as we've chopped around here in the last couple of weeks. But if you look on the next couple of pages, what happens is when we have these really strong periods of outperformance, people tend to get, wouldn't say necessarily greedy is the top word that comes to mind, but enthusiastic. So CNN has this fear and greed measure that we see here on the gauge. And a little bit of that is good because that drives momentum, that drives forward prices to continue on the path that they're on. But it does give us a little bit of a pause. And often I feel like our job on these webinars is to be a little bit of a pick-me-up when things aren't going so great, to try to put that in some historical perspective, and then maybe to temper expectations just a little bit when things do get a little bit maybe overheated or greedy. So when we think about greed, how do we measure that objectively? We start to think about valuations. And Scott, if you'll just jump forward to that next slide, this is something we're intimately aware of all the time, is what are we paying for the stocks that we own in our portfolio? And there's a lot of numbers on the page. I promise not to go through all those in great detail, but visually you can just see here that the price to earnings ratio is starting to creep back up to where it was even in 2021 before this most recent bear market. And you could, I guess, take the glass half full approach and say that's the market predicting really great earnings growth in the next 12 to 18, 24, 36 months. And I think we're going to dive into that with the topic on AI. But anytime you see something that's beyond one standard deviation of normal, it should at least catch your attention. That means that things are a little bit expensive, at least based upon some of these historical metrics with that most recent run-up that we've seen. And again, just sort of transitioning here, a lot of that's been driven by some concentration in a handful of names. So on the right-hand side of our slide, we see that now the top 10 stocks in the S&P 500 represent 1/3 of that market index. So again, we think we're diversified. We own 500 stocks, well, 1/3 of our portfolio is in 10 of those if we just own that S&P 500 index. And those top 10 actually only contribute about 1/4 of the overall earnings. So while they do represent 1/3 of the market cap, only 1/4 of the earnings is represented by those top 10 stocks. But more so than the top 10, the term that's been thrown around by talking heads on larger programs in this one has been the Magnificent Seven and the performance of those top tech names. And these are just some remarkable numbers which are worth reviewing before we dive into it in more depth. The Magnificent Seven returns in 2023, you can see in that chart in the top left-hand corner, were up on average of 76%. So those 7 stocks had a 76% return on average last year. The rest of the S&P 500 had an 8% rate of return. Now those 7 were enough to give us a total return of 24%, which was great. But it just shows you again how concentrated we were in some of those names. And what's in the Magnificent Seven, you can see it noted at the bottom. It's Apple, Amazon, Google, Facebook, Microsoft, NVIDIA, and Tesla. Some of those, Tesla and Apple in particular, have underperformed so far this year, but the narrative around AI and semiconductors, most notably companies like NVIDIA, and then on the software side, companies like Microsoft, is really what's grabbed the market's attention. It's given us this catalyst for some excitement here. So Scott, I think it's a great time, with that being such a focus, for you to take a little bit deeper dive into AI and try to answer the question, are we in a bubble? Should we be concerned, or are we still in the early innings?
Yeah, thanks, Eric. So what we try to do to answer that question is provide a little bit of historical context. But to start with, let's just level set. There's been obviously a lot of interest in AI, and you can see that quantitatively. On the left, this is Google Trends searches for AI, people just Googling, what is AI? And you can see it's 10x'd over the past 18 months with just broader general population interest in what is this and what does it do and how can I use it? In addition to that, on the right side, corporate America has obviously bought into this as well. If you look back from 2017 to 2022, only about 1 in 10 companies were mentioning artificial intelligence on their earnings calls. But once we got the launch of ChatGPT and some of these large language models in 2023, that immediately spiked to 1/3 of companies mentioning it in Q3 last year and almost 40% by Q4. So every company in America is thinking about how can I use this in my business? Where will it impact my positioning with my clients, with my competitors, and what can it do for me? And what we did is we looked at some economic research that was put out by Goldman Sachs, where they have some very intelligent economists that studied where they think artificial intelligence will impact employment in various sectors of the economy. What this bar chart shows you from left to right is more labor-intensive physical jobs, starting with building and grounds cleaning all the way on the left. So definitively manual labor that has very little risk of automation from AI, all the way over to the right to computer and mathematical computation, which has a significant risk of impact from AI tools. And impact doesn't mean it's going to make everything go away. It just means that these are industries, jobs, segments of the economy that are going to be materially impacted. And the gray bar at the top, those are elements of jobs that will likely be replaced. And so if you look at the dark blue, the light blue, and the gray, what you see is this sliding scale, where as you move to more knowledge-based, computational, data-intensive jobs, obviously AI is going to have a high impact there. Or on the right, the more physical labor, trades, manufacturing, physical assembly, and tasks will obviously have lower exposure to AI. If you look in the middle, all industries on average, about 30% of them should have no impact from automation or de minimis, sub 10%. About 90% will have AI acting as a complement, as in helping people get more productive. And then about 10%, 5 or 10% will likely see replacement of that task. And we highlight on the right, what's most relevant to the three of us is business and financial operations. We as an investment team managing money, we're actively already using artificial intelligence to complement what we're doing. So it's kind of a real world example of how we as an institution are using these tools. One instance is as a research co-pilot. Just in preparation for this presentation this morning, I wanted to know what the historical 10-year annual productivity growth has been in the U.S. economy. I could have gone and Googled for a half hour and looked for a bunch of statistics and tried to make some math assumptions on what the average was. But instead, I just put it right into ChatGPT, and I get back a sourced answer from the Bureau of Labor Statistics that tells us it's been about 1 or 2% on average. So there is an example of me saving, 30 minutes to 60 minutes by just using ChatGPT as a research co-pilot. Another example would be when we're building ways to manage our portfolios and do portfolio management analysis and tracking at scale, we write a lot of code in programs such as Python. And in the past, where our team would have to manually start from scratch and write code to generate a regression of variables, we can now use ChatGPT to start us on that path. We just enter a question and ask it to create code for us, which gives us a great starting point in terms of what that code base should be. Now, obviously, you have to go in and edit things. It's just the first attempt. We're not handing over the keys entirely, but it saves us time and energy on kind of that base level work. So again, finance and business operations is a good example where we're already seeing AI as a complement to what we do on a day-to-day basis. And you can even go even deeper into this and use AI for image creation. Some of these applications are more fun and interesting as opposed to impactful on a day-to-day basis. But for instance, here, if I ask an AI image generator to create an image of a Midwestern investment portfolio manager, it's plausible. It's a little bit stylistic, but it looks like either a young Warren Buffett or an old Eric Krause. But you would look at this person and say, yeah, that's reasonable. That's probably what a Midwestern portfolio manager would look like. However, if you go a step further and ask AI to create you an image of a Midwestern investment portfolio manager with a lot of children, you get what we call a hallucination. And this is one of the issues with these AI tools. They're not quite ready for prime time. In this case, where you would expect to see someone with pictures of children on his desk, instead you get a 5-year-old portfolio manager with a bad haircut. It's impressive that AI knows that 5-year-olds always have bad haircuts, but it's also concerning that this is what a model spits out as what a portfolio manager with a lot of children would look like. And we bring this point out just to give you an example of why it's going to take a while for these tools to materially impact the economy. If you look at some precedents of big technological revolutions and big new technologies that have sort of revolutionized work and production in America, there's two examples that come to mind. One would be electricity in manufacturing in the late 1800s, and the other would be personal computing. And so electricity in manufacturing, it really was invented in the late 1800s, early 1900s with the development of the electric motor. In the case of personal computing, that was started in about 1980. But what you see here in these dots, these diamonds, is that adoption, which is this left-hand scale, takes a while. Personal computing in red and electric manufacturing, for the first 5-10 years, there's only a few percent, 10%, 20% penetration of those tools into these industries. And it really isn't until you reach this about 50% adoption threshold where you start to see real productivity gains in these sectors. Again, if you think of AI hallucinations, or if you had an electric motor in 1910, it probably didn't work all that great. If you had an early stage personal computer, it did some stuff, but it was more fun rather than super productive. And we think that AI will follow a similar trajectory where over time, over 10, 20 years, we'll start to see a similar boost in productivity. But it's just not immediately, it's not out the gates. On this left-hand panel here, again, these are from Goldman Sachs. The development of the electric motor was around 1890. You didn't see a real productivity gain from that until about 1925. The personal computer in 1981 didn't really start to filter through to productivity gains until around 2000. And so the point is, these things take a while. Adoption matters, working out the kinks matters, and not to be forgotten, there's a lot of other factors that impact U.S. economic growth. There's recessions in here. There's labor tightness, labor excess. So there's other things that drive U.S. productivity. But over time, these technological revolutions tend to be a boon to the U.S. economy. If we look over on the right, these are some estimates on how much potentially AI could affect annual productivity growth. The mid case is it might add about 1.5% to U.S. productivity, which is material and is similar to what you saw from the electric motor and the personal computer. Remember what ChatGPT told us, the baseline is about 1 or 2%. In the case of the electric motor and the personal computing, it spiked up to about 3%. And we would think as a baseline, that's probably where AI ends up impacting the economy. Now, there's more bullish cases that say it could be as much as 3%, and more bearish or conservative cases that would suggest it might be only 0.5%. But the point is, at some point over the next 5, 10, 20 years, we're going to start to see some material improvements in U.S. productivity as these tools become more widely deployed. Now, what we also want to be cognizant is the history of people getting a little bit too excited about new technologies in the markets. An obvious historical example is the dot-com boom. In the mid-late 90s, as internet companies were taking off, there were some of these large technology, media, and telecom companies, or TMT companies, that saw huge expansions in both their growth rates as well as the multiples at which they traded in the markets. However, if you have very high multiples, your growth has to be in line or better than what the market is underwriting. And what happened with the case of Cisco, Microsoft, and Intel was that the market got ahead of the actual growth in earnings. And if you look at the bottom in this table, from 1999 to 2000, in 1999, Cisco was up 130%, Microsoft was up 70%, Intel was up 40%. The realized sales growth from 1999 to 2001 was below what people expected. For Cisco, people assumed that 2-year growth was going to be 40%. It was 11%. For Microsoft, it was supposed to be 16%. It was 10%. Now, those are still very healthy growth rates, but what happens when you undershoot on expected growth is your multiple contracts. And if you look all the way over to the right in the lower panel, the next 12 months, the valuation of the firms relative to the next 12 months sales went from 20 times on Cisco in March of 2000 to 4 times a year later. For Microsoft, it went from 20 times to 10 times, and for Intel, it went from 13 to 6. So you can see your multiple cut in half while still growing reasonably if the market just underwrites too optimistic growth rates. When we look at TMT valuations today versus the dot-com bubble, we see a little bit of excess, but not nearly to the same extent as it was at the peak of the dot-com bubble. If you look around 99, 2000, those top 10 TMT stocks are trading between 40 and 50 times median forward earnings. And if you look at the post-COVID boom in late 2020, 21, things were trading at 40 times earnings. Right now, for these top 10 stocks, it's about 28 times. And that's certainly above the historical average, but it's not at the same levels of euphoria and inflation that we've seen in the past. And again, we think it's more a function of when these productivity gains and these boosts to earnings flow through, not so much a matter of if, but we want to make sure we're not getting ahead of ourselves and underwriting too much growth too soon. And to this point, when you look historically, it's hard for companies to sustain sales growth for a long time. This chart on the left shows in the light blue the percentage of companies that were able to keep sales growth above 10% for consecutive years. Now, there's 90% of companies have been able to keep sales growth north of 10% for 1 year, but only about a third of them were able to sustain that over 5 years, and only about 1 out of 10 could do that for a full decade. And if you think about even more robust sales growth assumptions in that dark blue line, only about 10% of companies can grow at north of 20% for 5 years, and only 3 could do it for 10 years. So when you're seeing companies that are assuming 10, 20% revenue growth, we got to be very disciplined and know that that's a rare thing, and be super confident that that's actually going to be coming through in the earnings and that we're paying the right price for it. On the right-hand side, similarly, on earnings margin, a lot of these early companies that have been key beneficiaries of demand for AI chips, they got very high margins, but it's hard to keep your margins high when you have competitors circling and trying to take your business. And so again, we just want to be mindful of what's being assumed in the forward revenue and earnings growth relative to what you're paying for those stocks. And when we do this, historically, back in .com, the median expectation of earnings growth for those top 10 companies was about 24%. And if you look at where things were post-COVID, when the market got a little bit inflated, the median was still almost 18%. Right now, for these top 10 TMT stocks, the median is about 15%, and that's above the S&P median average of 11%. But again, it's not as inflated, not as elevated as we've seen both in the .com era or post-COVID. And finally, if you look kind of market wide, expanding out beyond these top 10 TMT companies, the entire market got overly optimistic in 2020 to the tune of expecting 16% long-term growth expectations, whereas now the market's implying a little bit more than 10%. Now, again, that's above average. It's above the long-term average of 8 or 9%, but it's not at the same inflated point we've seen in past cycles of a bit too much market euphoria. So to wrap it up, I think, are we in an AI bubble? We don't think it's a discrete bubble to the same extent that we saw in the tech era of 2000. We think that there's a little bit of inflation on some of these names, but longer term, we do think AI will be a big productivity boost to the US. It's just a matter of being reasonable in terms of when you think that's going to come through and having the patience and the discipline to buy companies right and not overpay for earnings that are still 10 years away. Eric or Will, anything to add to that?
That's great from my perspective, Scott. I appreciate the deep dive on that this quarter. I think that has been driving markets and will continue to drive markets at longer term impact. So that was great information. Well, I'm not sure if you have anything you'd like to cover there.
Yeah, I was just call Scott out for leaving out the context of a Midwesterner with a lot of kids.
That's yourself, right, Scott? How many kids do you have? 17?
I have more than you. So yeah, that would be me as well. My family photo kind of looks like the kid with all those pictures in the back. All right, so let's zoom back out. We went deep into AI, but there's obviously other things driving the market. We still have inflation in the back of our minds. We're still waiting to see what the Fed does. I guess the question here is, how is inflation trending and what do we expect from the Fed? Eric, maybe you can take us through this one.
Yeah, unfortunately, it's not trending quite as well as we'd hoped it would, or at least that the market hoped it would just recently here. You can see if you just kind of focus on the far right-hand side of that chart, on the just back one, if you don't mind really quickly. We're certainly way off the peaks of 2022 when we were posting some 9% headline inflation numbers, but we've kind of got stuck here. And I still credit Scott with this commentary early on that the trip from 9 down to 4% wouldn't be too difficult if we could relieve the supply chain. But the trip from 4% back down to the 2% Fed target is going to be a little bit tougher to achieve. So if you do look at that next slide, you can see how things have sort of stalled out a little bit, the different contributors to inflation. And that report that we got this morning showed headline inflation was at 3.5% again, which again, big relief from 8-9%, but not where we want to be long term. And unfortunately, some of those areas of inflation that maybe were helping us out last year as we sort of work through some of that extreme pain are starting to creep back upwards. So when we think about oil prices, what we're paying at the pump, it's not again those extreme levels, but oil prices in the mid 80s, touching $90 a barrel, certainly has an impact on our day-to-day spending on gas and fuel. And then we're starting to see there's almost this whack-a-mole of category. In the most recent category that's garnering all the attention is auto insurance. And I think they almost lull us to sleep with monthly payments and quarterly adjustments that they don't really tell us about besides just the ACH to your checking account. But some of those numbers have grown at extremely rapid rates on both auto and the homeowners and the health insurance rates. So across the board, that's a real impact to everyday consumers. So suffice to say, it's not where the Fed wants to see it yet. And when we look at the next slide, we can talk through the Fed expectations of interest rate cuts. Now, when we shared this slide in our last webinar, we noted that there was a pretty significant disconnect between what the market was expecting, which was roughly 6 interest rate cuts in 2024, and more realistically what the Federal Reserve was projecting, which was in the 3-cut range. Well, now all these Fed presidents are almost having a competition who can be the most hawkish or push this out the furthest, saying, hey, maybe we don't need to cut rates at all. And then somebody will come over the top and say, well, maybe we actually need to increase rates again if these inflation numbers stay high. I don't think that's a likely outcome, but going forward, these rates are likely to go down in the next 12 to 18 months, but at a much more guarded pace, absent something, frankly, that we don't all want, which would be some sort of economic shock. So we'll see what happens. I think Goldman's reading on it here this morning was maybe there's 2 rate cuts this year. Maybe the first one got pushed from June to July as we move back down towards neutral.
Okay. So I guess with that being said, the Fed is looking at financial conditions. They're seeing overall macro activity, they seem pretty comfortable that keeping rates high isn't going to hurt anything, at least for the next month or so. Will, what's driving the macro strength, and what's the Fed going to be watching to determine when and if they do start to cut?
Yeah, if you think about the Fed, they've got two goals in mind: price stability, which Eric just covered, and then maximum employment. And so let's focus on that for a second, and then we'll get into some consumer metrics. So if we look at the unemployment rate and then the wage growth rate, when we showed you the slide a quarter ago, the blue line on the far right of the chart was higher. So wage growth has come down, and we'll get into some of the dynamics around that in a second. But unemployment rate has stayed kind of sticky. We're below 3% on unemployment. So the Fed is viewing the maximum employment, if through the unemployment rate, they're meeting that objective, meaning that, you know, the goal is to have the most people employed in the country as possible. So we're doing good there. If we jump over to the consumer, there's labor demand and labor supply. So we're going to look at labor demand first. So this is companies need demand for employment. And if we look at JOLTS and the amount of job openings that are out there, it's come down. So demand is waning, and which is not a good thing. So you want to have a lot of demand and a lot of supply, which is how you get to maximum employment. So this is something to watch. You know, how much demand out there for jobs is there. And if we jump to supply on the next chart, we're actually seeing a little bit of an increase in supply, mainly through immigration. So the top right is the labor force growth, native and immigrant contribution. And you'll see that the foreign-born contribution in blue comprises most of the labor force growth for 2023. We'll try to keep politics out of this, whether that's a good thing or a bad thing. But nonetheless, there's more people looking for jobs that are foreign-born than native-born, with fewer jobs to be had. So in a Fed lens here, you're at maximum employment with, you know, they got to figure out how to create more jobs so that all the supply can be absorbed by the demand that's out there. If we think about the consumer, which is the next slide, a lot of studies show that the consumer comprises about 70% of US GDP. And so how are consumers doing? Well, consumers are still living off of the glut of stimulus post-COVID. So all the rescue packages, whether it was direct to a consumer or through payroll protection to companies, there's just a lot of cash that was floating around out there, which led to supply chain crisis and could say led to the inflation issues that we're seeing today. And essentially what happened is investors hoarded this cash, or consumers hoarded the cash, and they're slowly spending it down. And the top right chart shows you the blue area is the peak excess savings of like $2.3 trillion. And we're slowly burning it down. So as the Fed has raised interest rates and increased debt service and the cost of goods, consumers have cash to help absorb those price increases. Now, it's not great. None of us like to pay more for goods and services. But that said, there is more cash out there that's helped buffer some of that. And as a result, on the left side with the personal savings rate, you'll see it's only 3%. Whereas historically it's been north, or the average is 8%. So consumers are saving less today because we're in a spend down mode from the COVID stimulus. And this has given the Fed some runway to orchestrate their kind of no landing scenario with all the recession forecasts that we talked about again in this time 3 months ago. So we got, I think, one more on consumer finances is, you know, again, speaking to the consumer household here is, I'm going to focus on the bottom right here. And this is where there are delinquencies. So the student loan is the most obvious standout on this chart. You'll see it kind of goes from 10% down to nothing with the, you know, whatever you want to call it out of Washington, D.C. with, you know, forgiveness of student loans. But we're seeing auto and credit cards tick up a little bit there. So not only are you paying higher insurance premiums for auto, your car payment, if you have one, is going to be a little bit higher these days than not. And there was a great refinance when rates were low and before real estate kicked off, you know, prices going higher. So a lot of folks are hopefully in a very low mortgage payment based upon a lower insurance rate. You know, some of us do have to move for other reasons, job, whatnot, where you're going to have 7% mortgage this day. But that said, that the debt service of the consumer side of the balance sheet is still pretty low. and the asset side still looks pretty good. So the Fed is in this kind of grace period of inflation actually helping the consumer. As much as we don't like to pay higher prices, it's given us a little bit of a balance to have some savings to ultimately absorb the higher prices to let the Fed maintain or hopefully get back to price stability of 2% inflation while maintaining maximum employment. And so with that, Scott, we'll turn it back over to you for our final session. Oh, sorry, I missed one slide. So actually, if we hop back here, when last quarter, the probability of a recession was 50%. And we were kind of saying that's a coin flip, right? No recession. I would say the weight of the evidence was leaning more towards the soft landing or no recession scenario. So it makes perfect sense that the market is now implying a 35% odds. I would still say that's probably a little bit high as we're threading the needle here on a no recession scenario. But we'll see if next quarter when we show you this chart, if it's below, probably should be down about 20% if I was a betting man. So with that, I'll finally turn it back over to you, Scott.
All right, thank you, Will. So there's a lot of moving parts, obviously, as always, and we haven't gotten into. We didn't recap kind of what we did last quarter around elections. If you're curious about election impacts, I'd encourage you to go back and listen to the webinar from last quarter, where we made the point that typically elections have more of a muted market leading up to them, but as you approach elections, the market tends to do better over a short term, and over the long term, elections really don't matter. It really comes down to just overall U.S. economic growth, which has been consistent and strong for 100+ years. And so our advice with respect to elections was, if we had to handicap short-term moves around an election, they tend to be positive as you approach or exit elections. In longer term, we wouldn't use it as a reason to not invest because over the very long term, it typically is not that impactful. So maybe Eric, I'll turn it over to you to wrap us up. With all this backstory, AI, Magnificent Seven, markets up strong and start the year. Give any final thoughts or perspectives on kind of how our clients, how investors, how people that are trying to save for the long term should be thinking about the current environment?
Yeah, again, I think I mentioned earlier, sometimes our job is just to encourage people to stay level-headed, and we probably get a little bit boring with the same methodology and same words of wisdom, if you will, of not panicking when things get so uncomfortable in the markets, and not getting too exuberant and chasing things when they get to all-time highs. But then I wanted to present a chart here that's almost counterintuitive related to that point on all-time highs, because I think a lot of investors are either in two camps right now. They think NVIDIA is going to go to 3,000 and these semiconductors, AI is going to revolutionize everything. They want to partake in that. They want to participate. And in the other camp, you have people that say, well, gosh, it's not a good time to invest now. The market's at an all-time high. And this chart actually serves as a way to sort of refute that argument, at least over the short term. If you look at the right-hand side here, again, this was almost, to me, I wouldn't call it mind-blowing, but very interesting. And maybe that's because I like charts and graphs so much. But still, if you look at the right-hand side, we see those numbers in the green. Those are the numbers that represent if you invest at a new all-time high. So if you pick the day when the market reaches a new all-time high, intuitively we would think that's not the best time to invest, right? It's better to get it cheaper. We want to buy low and sell high. What this chart shows us is that actually when a new high is set, it's a great time to invest, because that's usually a reason there's going to be some momentum and some follow through. So on the right-hand side, you can actually see that the 3-year returns from investing on a new high day are higher by 8% than any other day, invest on any other day. So, next time you see the news, the CNBC headlines, say, shoot, I missed it. The market's already at an all-time high. It's not a good time to invest. Certainly we want to be prudent and be diversified, maybe dollar cost average if we've got a lump sum of cash to put to work, but it shouldn't cause us so much fear that we just miss out on the next 10 to 15% market move while we're waiting for a 5% pullback. Secondarily, I guess the other message that I would have is beyond just that, try to get over the paralysis of being overly exuberant or sitting on the sidelines, stay a little bit more in the middle. But also, there's a reason to believe in the rest of the market too. I know we focused on AI, but Scott, if you'll jump to that next slide, this really focuses on the performance of that market cap weighted index, so the one that's dominated by the concentration, versus an equal weighted index. So if you took all 500 stocks and bought an equal share of each of those 500 companies. And this goes in cycles also. We've had a really impressive cycle here recently where that market cap weighted index, the one that's been driven by those top tech companies, has really outperformed. But if we do see this soft landing scenario where the Fed is able to get inflation under control, it's likely that you'll see a broadening out in market participation from some small caps, some mid caps, other parts of the US markets, and even more notably, probably on the next page, other segments of the market in general, the global marketplace. When we think about what's going on valuations wise, and anytime we look at long-term, so 10-year plus capital market assumptions, recently they suggest that there's room for some outperformance from international equities, whether that's developed markets, emerging markets. And I guess the last thing that I would add here for diversified investors, don't sleep on bonds at this point. I know it's kind of, again, a boring topic to talk about treasury bills or municipal bonds, but there's an opportunity today that we haven't had in 15 plus years, where you not only get a current income yield of 5 to 5.5% on investment grade corporate bonds, you have the opportunity to also get some price appreciation if those interest rates go back down. So my closing message there again would just be, stay level-headed, but also stay diversified, and don't let one narrative drive your portfolio. Don't get too caught up in one segment or one story, because we know that diversification helps us out in the long run, produce those predictable results. So I don't know, Will, if you have any thoughts on that.
Well, I would just say, Eric, I think you're correct. We are somewhat of a counterweight to sentiment, or at least that's kind of the role we try to play, is when the markets are down and people are bearish. That's usually, a better than average time to invest. And when markets are maybe a little bit frothy, the thought about, maybe dollar cost average or just take a longer term perspective is true. Hopefully we mitigated some of the boring nature of the commentary with the deep dive in AI. But to Eric's point, for our clients who like to focus on the long term, and if you stay invested and commit to a strategy, things tend to work out pretty well. So with that, I will end it by just noting a couple upcoming events over the next couple of months as we enter the summer season. In late April, we have our Fit for Learning seminar on crafting your financial safety net. That'll be at noon Central Time on April 24th. We'll be back, the three of us, on July 10th with your Q2 wrap of Making Sense of the Market, or rather Q3, I guess it would be. And then we'll have another ERISA attorney talk on August 13th, and maybe some additional events over the next few months before we get to August. So with that, I think we'll wrap it up. Thanks everyone for tuning in. Hopefully you found this informative. If you have additional questions or anything we can help you with, please reach out to your advisor, and we'll be happy to help. Have a good day, everyone.